Hi everyone, it's MJ, and in this video I want to talk about the bond market. Now when I grew up, bonds were considered boring, they were considered secure, and I kind of thought that they were for old people who kind of found the equity market to be just a little bit too risky. However, the bond market, especially the bond market today, has become very interesting with their negative interest rates. And this is a little bit confusing for a lot of reasons. For one, it goes against one of the most fundamental rules of finance, and that is the time value of money. If I give you money today, then I can expect you to give me money tomorrow with a little bit extra. And this little bit extra is to compensate me for two things. One, the credit risk. This is the chance that you might default, which means you take my money and you run away. Please don't do that. Or number two, it's to reward me for the fact that I've given up this money and I could have used it for something else. We call this opportunity cost. So it has always been that when you give money, you're expected to get some back plus a little bit extra. However, what we're seeing now, well, it started quite a while ago and economists thought, it's just going to last for a little bit, it's the bond market's misbehaving, they're going to get in line soon. It was this whole idea of negative interest rates. However, the negative interest rates have not only prevailed, but many people believe that they're here to stay. And why this is a problem, it means that you're giving money to people and they're giving you less money later, but you're still taking on credit risk and you're still taking on the opportunity costs. So how did we get there? Well, it kind of started with the whole, global recession, everything went crazy, and central banks thought, hey, it will be a great idea to lower interest rates. By lowering interest rates, it made people, gave them less incentive to save and more of an incentive to spend their money because they would generate less interest, and it would just be better to enjoy your money now as you're not going to be getting that much later. So what that did is that by making the interest rates low, bonds had to also be issued at quite a low amount because they didn't have to really compete against the money market and bank accounts. They could get away with issuing less for less interest. And remember, they've got an incentive. The less interest they pay, the better it is for the bond issuers because it means they get to keep more of the money. So the bond market was quite happy to do this. However, what started happening is people would buy bonds and then keep buying bonds, and demand, this is supply and demand, basic economics. Because the demand for these bonds were so high, the price started to increase. And when prices of bonds increase, the interest yield that you get on them decreases. But the price of the bonds went so high that the yields became negative. So we now need to ask the question, why were people buying bonds? Why would you buy something that gives you a negative interest rate? And it turns out that in a lot of these cases, people are being forced to buy bonds. Yes, that's right. You are getting forced to buy bonds. And in many instances, people are unaware that they're doing this. Now, in South Africa, we're a little bit fortunate. Our bonds are like barely investment grade, so they're pumping out 10% and, everything's going good here. But in countries like Japan, and we're also seeing it now in Europe, interest rates are negative and they're going to be negative for a long time coming. And like I said, this is because people are forced to buy bonds. What do you mean people are forced to buy bonds? Well, what people do is they save for their retirement by investing in a pension fund. Now, pension funds have regulations, and these are rules which were originally made to try and safeguard them, because before people would take the pension fund, put it all in an equity stock, and either the old people could live in mansions or they couldn't even afford an old age home. It was very, very risky, very, very volatile. So regulation came in that forced people to buy bonds because they were seen as boring and secure, and the returns were modest but acceptable. With the cut in interest rates, they still had to buy bonds because regulation forced them to buy bonds. And remember, pension funds are one of the biggest players in the market. It's collectively, basically, the people of a country saving together. And if they're all being forced to buy bonds, there's going to be some serious demand pressure on that price, which, like I said, is going to lower the yield. But now you might be saying to me, hold on. Why don't they just change the regulations then? Well, let's think about it. Who creates the regulations? It's a government body. And who benefits from negative interest rates? The government. So they're not in too much of a hurry to change that. But then you might say, hey, why don't people just stop, putting their money into pensions? Nothing forces me to put my money into a pension. Well, in some workplaces, you are forced to put money into your pension, or you're rewarded. For every amount you put in, the company matches or something like that. So you're a little bit silly if you don't. Also, if you don't invest in a pension and you start to rather save yourself, you're going to be open to a whole bunch of taxes, capital gains tax, dividend tax, all these other things. And the negative yields aren't that bad that they're worse than tax. So people are still buying these bonds. Now, as a trader or as people in the speculative market, if I know that the demand is going to be constant and people are going to keep buying bonds, as a speculative trader, I'm also going to buy bonds. Even though the yield is negative, I'm going to buy it because I assume that the price is going to get higher and higher and higher. The yield is going to become even more negative, and I can sell it at a later date and actually profit from these negative yielding bonds. And of course, what this does, it puts even more pressure on people to buy the bonds, which even forces the interest rates, down even further. So now you're probably wondering, but hey, if you're talking about demand and supply, and if price is pushing up, why don't they just issue more bonds? Why doesn't the supply increase? And this is where it gets a little bit interesting, because supply of bonds is already huge. I mean, we're talking about trillions of dollars. I mean, the bond market is much, much bigger than the equity markets. It's bigger than anything else. So already supply is excessive. But governments know that they can't just, willy-nilly issue bonds, because the more bonds that they issue, the less infrastructure and base assets that they have in order to secure this debt. Because remember, you're only going to lend money to somebody if you know that they're going to be able to pay it back. If they start lending, or if they start borrowing lots and lots and lots of money, you're going to be thinking, how are they going to repay everyone? And there's these agencies that kind of keep the governments in check. Look, they got a bit of a bad rep because they stuffed up with the whole world recession, but let's give them the benefit of the doubt. These credit rating agencies monitor governments and the amount of debt that they issue. The more debt that they issue, the less secure the government is. And the less secure they are, the weaker the credit rating agencies are going to view them, and they're going to give them a bad score. If their score decreases below a certain level, if it's no longer, triple A, or if it's no longer investment grade, then what's going to happen? The regulations are going to kick in that say that, these pension funds have to buy investment grade bonds, which means there's going to be a massive sell-off. If there's this huge sell-off, traders are also going to want to start selling off. And we're going to see a huge crash in the bond market. And it's probably going to, the recession caused by that is going to be a lot longer than that caused by the, subprime recession that we saw in 2007 to 2009. So governments, they're enjoying the party, but they know that they can't, overcapitalize from it. So you can't just go out and issue too many bonds, because you could be shooting yourself in the foot. But this does leave us still in a pickle, because right now, people, so pension funds and insurance companies, and generally the people who want this long-term exposure that bonds can offer, and they want the security of it, they're getting penalized. So this is making insurance more expensive, and it's decreasing the returns of pension funds, which means people have to work longer. Also, pension funds are getting smacked on the other side with people living longer, which means the little bit that they're now getting has to last a lot longer. So pension funds are not in a good state right now. And it's no wonder that they changed from being a defined benefit, where the companies took on the risk, to defined contributions, where they've shifted the risk back onto the people. So people in pension funds, it's not a happy state right now. The thing is, pension funds fall under the actuarial science curriculum. And the solution to this problem is, well, I think it has to come from the actuaries. We're trained to understand these markets. We're trained to, understand the maths that goes behind it. So essentially, what I'm basically saying in this video is, because I know most of you watching are either actuarial students or actuaries yourselves, we need to actually think about a solution. We actually need to try and save the world. So put on your thinking caps and let me know in the comment section below how you think we can solve this problem. Now, we know as actuaries, the 3 steps that we go through is define the problem, develop the solution, and monitor what happens while being aware of the economic environment and behaving in a professional manner. So the problem is that pensions are suffering from the negative yields of bonds. That's the problem. The solution, guys, I'm going to leave that up to you. So please let me know what your thoughts are. Look, I'm not expecting you to listen to this video and then in 5 minutes come up with a solution. This is something that I want you to think about in the coming months. Read articles about it. But at the end of the day, it's going to be up to the actuaries to come up with a solution to save the world. So with that bombshell, I'm going to say cheers and I'll see you guys in the next video. Keep well.